Well, very good morning to our first virtual panel for this morning. We've got a very distinguished panel of account managers that have joined us today to give their views on what's happening in the market. We've still got a few people coming in, so we'll hang on another couple of minutes and then we'll kick off. My name's Rob McCoy. I'm the Senior Product and Business Manager at TMA, and part of my role is liaising with all the lenders and partners that we have within our lending panel. We've gathered together I was at an event yesterday and they described the panel as a motley crew, but I certainly don't think this is a motley crew. I think these are wise heads in the industry. Let's put it that way. So just to go around who we've got on the panel today, Andrew Calder from McCoy, who's our corporate account manager with them. Andy Sykes, corporate account manager from the Leeds Building Society, and we're going to call him Andy as we've got two Andrews on the panel. Jeff Williams, the National Key Account Manager from Santander. And last but not least, young Michelle Ash from National Account Manager at the Newcastle Building Society.
You can call me young all day, Rob. Thank you for that. Morning, everyone.
So I think we'll kick off straight away into the first topic. Affordability is probably the biggest obstacle for many applicants to getting a mortgage currently. So how are the lenders helping to overcome this? For example, are you considering increasing income multiples? So let's start off with Jeff at Santander. What's your views on this, Jeff?
Yeah, of course. Morning, Rob. So I agree with you in terms of affordability has always probably been one of the biggest obstacles, but we can see that there has been some good positive movements this year already within the market. So essentially, when we look at the stress rates, so we had the clarity that came through, I believe, around March time. And then the LTI rules was relaxed again in July. So we've had those changes come in, which meant that actually there's more affordability in the market in 2025 in comparison to last year. Now, looking at some of the Santander numbers, what we've seen is probably around 20% of our lending since March wouldn't have qualified in 2024. Which actually shows that these changes have actually really helped and made a difference. Now, the issue that I think that you're going to see from borrowers really is actually the monthly cost of these payments and also the requirement to have a bigger deposit as we're seeing property prices increase as well. So it's not just around the affordability. I think that we also need to consider the fact that the deposits are still difficult for people to get and also that people are spending more of their monthly income on their properties as well.
Andrew at Accord.
Yeah, I would agree with Jeff there. I think that we're in a much better place than we were a year ago from an affordability perspective with those stress rate changes and the regulator taking a little bit more of a relaxed approach to the amount of business you can do above 4.5 times LTI. I think that's something, as part of the Yorkshire Building Society, we were really, really keen to make happen. Ourselves and other members of the BSA were heavily involved in lobbying for that change because I think what you often seen was lenders were too scared to go anywhere near 15% for fear of going over it. And that's really helped us being able to make some changes in terms of bringing the minimum income required down to £50,000 to get above 4.5. Also be a little bit more targeted in terms of where we deploy that. We can now do up to 5.5 for first-time buyers over that minimum income. So it's been really helpful. But I totally agree with Jeff as well. I think the feedback that we get is that affordability is actually in a very good place. It's whether or not clients feel like it's truly affordable to them. So I think it'll be interesting to see how that plays out later on. And I do think, just to your point there, Rob, about, would we consider increasing income multiples? I think that we have to kind of be a little bit careful when we look at going further, because if you look back over the last few years, we've seen exactly why we had income multiple rules in place. You know, when you look at post-trust budget, when rates went through the roof, we've seen very little sort of arrears growth, which is great because that showed that the sort of prudency of the rules was doing what it was meant to do. So I think whilst there will absolutely be cases for being a little bit more targeted and maybe pushing things a wee bit in terms of the overall number, I think we still need to keep an eye on, let's just make sure that we're doing the right things for our customers, we're making sure that we're lending responsibly, and we're making sure that people can afford it should rates change in the future.
Okay. And so what more can be done to help first-time buyers, Michelle?
Yeah, it's interesting. Thanks for coming to us, because we've just launched a first-time buyer product to the whole market. So I'm really pleased that you've asked me that. I mean, first-time buyers, key area for the whole market. It'll be driving those transactions, purchase transactions. We're expecting for at least the next 12 months. We're expecting a rise in remortgages and PTs, but those first-time buyers are really on the lookout to get their first property. We've got a new product which is up to 98% LTV. It went to the whole market this week. Really great rate, 5.25%. 5-year fixed, no product free valuation. It's key for us. We've also got shared ownership. We've got an affordability boost, which will give you an income enhancement, income multiple enhancement. So that's taking that lower stress test because it's going to be over 5 years fixed. So we can apply a lower stress rate to boost that affordability. So if you're looking with us and you ideally want a 2-year and you're not quite getting enough, it's well worth going back and having a look at that longer term fix. So we're really trying to support the first time buyer market. It's a really interesting one because years ago, when it came to affordability and supporting the customers, we always had this issue with debt consolidation and the amount of debt that somebody had, particularly on credit cards. That seems to have gone. Now it seems to be the car loans. So we've got really good income earners with huge amount in car loans that we're trying our very best to give them as much as possible, but it is bringing down that maximum lending. So hopefully that people won't have any more new cars. Maybe it's because a few years ago you couldn't get a new car, so they've all held off. But yeah, first time buyers key part for us. But when it comes to affordability, it seems just to be those car payments that maybe are pushing it out rather than anything else.
So when you talk about the car payments, then are you saying it's the monthly amount or the total loan? Because obviously there's a lot more personal, what they call PCP plans, where there'll be a big lump sum in maybe 3-4 years time, but invariably the client changes the car. They don't actually need that money to pay off it. They'll probably buy another one, and the monthly payments might not change too much.
Yeah, it's the monthly payments rather than the lump sum that seems to be an issue. So we've had, particularly the last few weeks, because we've got a really great part of our policy for high earners, so over 75,000. So you've got people with over £100,000 worth of income, but they've got like a couple of Porsches and a Bentley on finance, and they're paying a significantly amount more on their car payments than they would pay on their mortgage. And it seems like that trend has changed from, maybe 5-10 years ago, where it was all to do with, the debt in the background, like your catalogues or credit cards and, just general loans.
Okay. Andy Sykes, but how about the leads? What are they doing for first time buyers?
Yeah, so thank you, and good morning to everybody. Those who don't know me, I've been with Leeds just a couple of months, but actually, what you might not know is for 5 years before that, Rob, I was a colleague of yours, wasn't I, at LSL for the last 5 years. So it's nice to be back on familiar territory, so to speak. So yeah, morning everyone. Yeah, a lot being touched on already in terms of obviously the changes to the stress rates, which has helped lenders to lend more. But from a Leeds perspective, I believe in some cases it's like we've amended our stress rates and it's allowed us to lend, or enabled us to lend up to about another 30,000 in some cases. So it's that those stress rate changes have made a significant impact. I also, we've also touched on that the LTI rule and the 4.5 times income and the amount of people you can lend to over that amount, and that's certainly helped us. And that probably feeds into that piece about what the leads have done off the back of that. And we've actually just launched a big marketing campaign about this first-time buyer marketing campaign this week, which has a couple of quotes in it. But the big thing for us is probably our halo product, so to speak. So we have a product called Income Plus for first-time buyers, and that allows us to lend up to 5.5 times a customer's income, up to 95% if you take a 5-year fixed rate or longer. And historically, or previously, we had a minimum income of that of 40,000, minimum household income of 40,000. And what the changes allowed us to do is drop that 40,000 household income down to a 30,000 household income. So it helps us capture a lot more single applicants between that 30 and 40. But certainly, if you're a joint applicant, 30 grand household income, it really captures a lot more people. The good news on that, if I just keep my sales pitch going for a second, is that it's available for employed and self-employed customers. Only one applicant needs to be a first-time buyer, and our definition of a first-time buyer is someone who hasn't owned a property for more than in the last 3 years. So a couple of little niches there for us in terms of that. In terms of how that's helped, this is with the analysis Leeds put out, I think it was earlier this week, but Leeds have done some analysis based on land registry research for the last, from a period of about 12 months. And what they found is that the fact that the drop of 40 to 30 as a household income would have opened up 51,000 more properties to first-time buyers that would have qualified to be able to buy a property with us at a certain purchase price. So, for example, prior to that 40 grand, prior to that 30,000 joint income piece, when it was at 40, if you're borrowing 95% at 30,000, the purchase price would have been 141,000 that you could have borrowed, that you could have bought at. Whereas now, by dropping to 30,000, doing 5.5 times at that, and doing 95% borrowing, you can now buy a house with a 5% deposit up to 170,000. So that's where the 51,000 properties that we're promoting this week in. I do think as well, going forward, while I've still got the mic, is just echoing what the people on the call have said already. In terms of affordability, I'm sure lenders are all looking to lend, so there'll always be tweaks, but it's how far you can go. I do think that deposit is the other key area. And that's why it was, I know, Michelle, you talked about it from a Newcastle perspective, that 98% product, I think is great. I think Accord have something with a 5,000 deposit, don't they, as well? And I think we might see more innovation in that sort of space going forward as well.
I was going to ask Andrew at Accord about their products, and what's been the take-up look like on that product, because it is quite innovative, really, in what you're offering there.
Yeah, so I think for us, 5K was a great example of looking at it as a business. First-time buyers at the heart of our strategy is a mutual. We want to help make home ownership more accessible, and it was like, how do we do that? Obviously, we've looked at affordability in quite a bit of detail there, and then deposit was the other piece that we mentioned before. How can we help people square that away? So yeah, £5,000 deposit will do up to 99% loan to value on a property value of up to 500k. And what we found is through the research to that is that it could cut saving deposit by 7 years. Could help potentially get someone into their first house or a couple into their first house 7 years earlier than they would have originally. So for us, that's a great thing. I think we were very prudent at the start, rightly so, in terms of there was an awful lot of controls associated with the product. We had an enhanced credit score, it was only available on houses, all that sort of thing, because at the time, the only other product you had in the market really was Track Record, which was 100% and is a wonderful product on its own. But given the fact that ours was sort of the first that was going to be assessed on standard affordability, I'd be lying if I didn't say there was a wee bit of nervousness about how much are we going to do on this, because it could have blown the doors off. So that's why we put all the controls on. But the take-up's been really good. I think with any of these products, if you look at ours, Track Record, Newcastle's 98%, obviously April's doing 100% now. I think there's no silver bullet in terms of what's going to fix the deposit challenge for everyone. But I think what is really encouraging is that you're starting to see more of them. To Andy's point, hopefully we start to see some more. Because we've helped over 1,000 families so far, into houses with that, and that's something really to be proud of from my perspective.
Yeah.
But hopefully, if you look at, there's 5 solutions there. If you get another few, then that starts to really change the dial meaningfully. But yeah, it's been a real success for us, and hopefully now we've been able to include flats on that proposition. Sort of alter the credit score to what we would normally expect for anyone above 85%, as opposed to that little bit trickier. We'll start to do even more of it.
Excellent. Moving on from the, it very much looks like, it's all vanilla type applicants that seem to be fitting in these products. With affordability has already been discussed, but interest rates are still high compared to what we've seen. And yes, they're probably coming back to what would be the norm that we knew before COVID. And now, of course, we've got cost of living pressures biting in. What are you doing with clients that are maybe have a minor blip on the credit file, and that you're looking to look beyond what the paper says, and to see the reasons why they might have had a credit blip or something like that? And maybe are the risk guys taking a little bit more of an open view on it? Andrew, you got the mic. You pick that one up.
Yeah, sure. So I think one of the things we've talked about as a core part to what we do at Accord for the last number of years is common sense lending. So I think there's always going to be a place for a conversation. If there's something that doesn't fit our criteria in black and white, absolutely pick up the phone to your BDM, because frequently our underwriters will look for a reason to lend as opposed to a reason not to. For example, defaults that aren't satisfied, CCJs, all that sort of thing. If there's a reason behind it, as long as the ones we always get are like tenants move properties, CCJ for utilities that we weren't aware of, mobile phone defaults, parking tickets, CCJs, relationship breakdowns, all that sort of thing. I think as long as we can see there's a reason for it, and it is, as you say, Rob, a blip, we'll absolutely look to do that, because I think it is real life, and we need to try and find ways to support customers with that. I think it's really easy to say that, though. I think something that kind of evidences that, from my perspective, we kind of walk the walk when it comes to that sort of thing, is that at any given time, between 25 and 30% of our lending has one form or more of criteria appeal on it. That's cold hard facts. So I think last year the total average was like 27%. So it's nearly 1 in 3 customers don't fit our criteria in one way or another, but we're still saying yes to them. I think the only thing that often holds that back, and or certainly historically did, is, as we are a credit score lender, credit score is sacred. If you don't pass credit score, there's nothing we can do about it. So I think it's about coming up for a couple of years now anyway that we introduced the Cascade score range, which means that for these customers that might have not quite got to the score that we'd want them to get to, we're still able to offer them a product, as long as we're happy with everything else on the case. And the take-up rate on that has been fantastic as well. And I think you're starting to see some more of that across the industry. And I do think that as time goes on, we'll start to see more sort of personalised products or personalised pricing, because lenders don't want to turn away business. They don't want to be saying no to loads of customers, because actually we'd rather hold on to them if we can. We just need to find a way to do it.
Jeff at Santander, I mean, memory tells me that there was always some small adverse that you would be able to get away with Santander. Is that still true, or is that now part of your policy?
Yeah, so there are some little bits that you can get away with, Rob. And I'll say that when we look at the credit files over recent years, what we've actually seen is a lot more information actually going on there. So Andrew's already mentioned a couple of them. You're now seeing things like your parking tickets going on there. You're getting utility companies now, mobile phone bills and things of that nature. And it's funny because in the past, people used to think, oh, I'll have an argument with O2 or Vodafone or EE, whoever it is, and think, oh, that'll be that. And I've shown them because I've not paid the bill. And there's actually now that's appearing on people's credit files. And actually more and more of these I'll say, separate from your financial product situations are actually now shown in the credit file and actually being recorded on there as issues. So I think what's important is to actually separate the difference between the financial products like your credit cards, your personal loans, your mortgages, and then a small blip on something like a mobile phone contract or a utility bill, if that's something of that nature. With us, I'd say it's probably still worth doing those soft searches. I know a lot of lenders do soft searches now. It probably is still worth doing the soft searches where the customers have non-financial product blips. So like I say, that's the mobile phone, utilities and things of that nature, because those are the ones that we're likely to be able to consider if we can look at those ones. But I think that the key message really and truly is, obviously, if you are going to be looking at buying a property, I think in terms of giving yourself the best opportunity within the market is obviously trying to have as clean a credit file as possible. But obviously, as we know, life happens and that's not always a possibility for everyone. And there are definitely lenders out there that will be able to look at that for them.
Okay. All right. Let's move on to vulnerable customers. And Michelle, you've done quite a bit of work on this over the last 12, 18 months. I mean, do you want to just talk us through what you're looking at from the lender's point of view and what brokers can do to help you as lenders?
Yeah, it's a big topic at the moment. And I was lucky enough that when I was looking at it, I had one of those brilliant phone calls in work where it says, can you have a look at this for Consumer Duty? And when I was looking at the Consumer Duty, Jeff's laughing because he's been one of the lenders that have worked with me for that 18 months. But when I was looking at it, I was thinking, God, this disclosure is really low. And I was genuinely worried. And what happened is I spoke to, Santander, like Jeff, and a lot of other lenders. Started off with about 11 lenders. And we were all finding exactly the same, thinking, God, this is a real key area. And disclosure is really low. And that's across the board. That doesn't matter if it's specialist, high street bank, building society, big, large, middle, doesn't matter. Across the whole board, it was low. We're pretty much 18 months later, that group that came together that started off with 11 is now up to 38 lenders, all trying to work together to help support brokers in disclosing. And there's been a couple of published papers that have come out. We've got one from UK Finance that published a voluntary code for brokers and lenders to abide by, and that's to do with sharing with information, standards, responsibilities. If anyone's interested in that, more than happy to share that with you. We've done 2 surveys. The latest came out a couple of weeks ago, which is asking brokers why they haven't disclosed. And for the first time, we asked our lender colleagues, why do you think brokers aren't disclosing, to make sure that we're all working together. We worked really hard to try and make it clear how to disclose. So that's what we worked really hard on in the first sort of 6 months of this year. So you would have seen a lot of lenders, Newcastle included, making enhancements, adjustments, making information available. I know Jeff, I'm sure he'll jump in at some point. They've got a whole, leaflet, guidance, loads of different information, which is there to help support the broker understand the types of customers to disclose, and more importantly, how to tell us if somebody is vulnerable. We've just had the results of the 2 surveys. There's a tiny bit of disconnect in what lenders think to what brokers think, and that's in terms of why people aren't disclosing. And I think the challenge for us now, because it's all about building on what we know, is about making sure that brokers understand that if you tell a lender, any lender, my customer is vulnerable, no matter what it is, you are able to communicate to that customer what happens with that information and what support they get. That's kind of the next part we probably all need to get really good at. But the first stage was really making sure it's clear how you disclose. That those disclosure routes are on a couple of the tech services that are available. And we're now working really closely with Amy, Networks Clubs, Rob, people like yourself, just to understand how do we work more together. And the priority is to make sure that the customer has the support they need. And we do get a load of feedback, mainly from lenders actually, that everyone thinks it's going to affect that mortgage application. That is not what the Consumer Duty paper is about. We've got a whole paper on the guidance for supporting vulnerable customers. It's there to personalise the advice, the support, and to make sure that that customer is fully aware of what they're signing up to. They've had the advice that they need. They understand what they're signing up for with a partner. That's a really big theme that's coming up when you've got two customers. Do both customers understand exactly what they're signing up for? Is somebody in a more vulnerable position because the other person is handling everything, and the abuse that can happen with that? So that's not just, a partner or a spouse. It could be an elderly relative, and if you're dealing with their finances. So it's quite complex, but all in all, it's there for us to work together to support the customer. And that's that's it.
Yeah, well done with all the work that you started off.
Oh, thank
It's
you.
obviously become an industry. You've become an industry guru on it as a result.
Thanks, Rob.
Jeff, you got mentioned a couple of times there from Santander. What's happening there?
Yeah, so I think Michelle mentioned that we sort of jumped in straight at the beginning to say, how can we support, how can we help out, and essentially how can we make it easy for all of our customers and brokers, essentially when a vulnerability does occur or is presented. And I think Michelle's covered it great, to be honest with you. And I think that one of the things that we sort of learned earlier was that some of the challenges was the fact that every single lender had a different process, essentially, when a broker went to them. And in terms of how you submitted it to them, some would have a separate form, some would be during the application. And so it wasn't very clear straight away in terms of, for some brokers, in terms of how they will actually report that vulnerability and what's actually done with it as well. I think the other part of it as well, and again, this is some anecdotal feedback rather than the actual results, because obviously Michelle says that we're waiting for those to be fully published. But what you find sometimes as well is because that the broker needs the explicit consent of the client to actually pass on the vulnerability as well. That's also where we sometimes see a little bit of a disconnect as well. So it is something that we will definitely keep very close to and make sure we're supporting our clients and brokers as much as we possibly can. And as Michelle says, we do have as many resources as possible on the Santander website, Santander Intermediaries website, and also through the broker channels to be able to support brokers and their customers should the vulnerability present itself as well.
So exactly, roughly where on the Santander website would anybody find this information?
So it's literally just, there's a little tab on there which talks about help and support, and it's just be one of the downs on there.
Right. Okay. Smashing. Right. Okay. Moving on from that then. So we've heard a lot about AI in the industry, and particularly how it improves the efficiency and time saving. But I'm going to go around that whole of the room here. Can you all share, what is it that you're using it for, where you've seen brokers using it effectively, and whether you'll see it replacing the human process? Jeff, you're on the mic. Do you want to start us off?
Yeah, no problem, Rob. I'll say that in terms of with AI, it's sort of like a buzzword at the moment, isn't it? It's sort of in everyone's mouth right now. But I think the main thing to say is that the mortgage is still the biggest financial purchase customers likely to make within their lives. And where we sort of see AI helping customers with market and product information, for them to just get a bit of an idea, but we still believe that the broker is going to be at the heart of the transaction. Like I said, it is the biggest financial transaction that people do, and generally what we find is that people do want to speak to someone, people do want the guidance as they are going through that big financial purchase. So I think that although that it will sort of help customers, help them get a bit of information, help them understand and navigate maybe the market in a bit more, I think that in terms of how complex the housing market can be for some people to fully understand, I think that they're still going to need that human touch of a broker. So I think that the AI might help the customer, but also help the brokers on their end. So that might help them to be more efficient when it comes to sourcing deals, maybe writing letters of that sort of nature, and also speak to people about their mortgages too. So I think that's where we're going to see AI really make a change in the sector, is more around efficiencies and helping people to do things that little bit quicker and read through things that bit quicker as well.
Andrew, it's a cause.
Yeah, I could speak for quite a long time on this. I'm quite a geek. I like this sort of thing. But I think, to Jeff's point, I think there's probably a little bit of AI fatigue as well, because I do think that is very much a buzzword just now. But I think that, it's spot on. If you look at it, first of all, from the sort of broker client journey transactional point of view, I don't think for a second it's going to replace anybody. In terms of, the point remains the same as Jeff said. It's the biggest decision anyone's ever going to make. They're going to want someone to hold the hand. I think there's also risk associated with that. Because let's be honest, there will be some customers that actually, think, I'm all right with AI. I've done mortgages. I've had 3 mortgages already. I'm just going to do it this way. But there are risks associated in terms of hallucinations and AI not getting it quite right. So I think it's going to be, brave businesses that take that on as a risk from a starting point. But I do think the key for me is how it can augment what we already do. As a broker, I think the quote I really like is, whether you like it or not, you're competing with AI. And then when you see that written down, you can view it 2 ways. You can either be it as you're competing against AI, or you can compete with it as your tool. Like, you can enhance your competitiveness. And I think that's probably the point where we'll get to, because ultimately it's going to change the way lots of workplaces work. Internally at the moment, I think as a large financial services business, we're still very much in that, what I would call, comfortable with AI stage. There's lots of things you can use it for in terms of, recording meetings, taking actions, notes, summaries, all that sort of thing. All the sort of repetitive tasks that no one really likes doing, about like taking data out of Excels and all that kind of thing, it's wonderful for. And I think the same from the broker side of things, writing compliance letters, summarising calls for clients, all that sort of thing. The sort of admin tasks that no one really wants to have to do, it will be great at doing. But I think all the value add things that we do on both sides of the fence, it's not going to replace, because it's not human. But I do think it'll be really interesting to see how it manifests itself, because I think there's certainly ways I could see lenders using it to increase our own efficiency and help us grow our own market share. When you look at underwriting, when you look at servicing, when you look at things that we'd normally like to do, but you might not have the manpower to do it or the people power to do it, I think that there's some real opportunities there. So it'll be an exciting few years to come. I think we're just at the start of it, though.
Okay. Andy, what are the leads using AI with?
Yeah. So, well, if I talk, so do I think first of all, do I think it's going to replace the human advice process, like the rest of the people on the panel? I guess the short answer is no. It's a personal opinion, this, from my point of view, but it's that power of customer data, isn't it? Because whoever holds all that customer data, for me, it's the AI will be able to improve the leverage of using that data in terms of marketing for clients. And you can see that across lots of industries, can't you, in terms of the focus on customer data. And if you think of it from bringing it back to our world, how many customers do we know go on things like the aggregators and then compare the Meerkat, and they're putting their customer data into that. And I'm sure there's far cleverer people than me sitting behind the scenes of those companies looking at how they can segment that data and use AI to sort of segment that data to then think about how they can market those customers. I used to work for one of the high street banks, and we all have current accounts. Think of all the data that the banks hold in terms of your current account data, in terms of your income coming in and your outgoings going out, and that can help going forward in terms of making processes more efficient, in terms of streamlining processes, but also in terms of segmenting the clients and identifying better products that I might, as a current account holder, be suited to. So it's those sort of things that I think we need to be wary of. And from my point of view, so I always lean back on the fact then it's so important then to keep in contact regularly with your clients. If your advisor, when I talk to fantastic advisors, of which we'll have them on the call here, the importance of, they'll know this, the importance of keeping in regular contact with the customers going forward is going to be absolutely key. But do I think, going back to this question about replacing the human advice process, no, I don't see it. I don't see that happening. As we all know, customers are individual, aren't we? We've all got our own little foibles and emotions and needs and personalities, and that's the skill of the advisor. That's why people want to still talk to people, to be able to demonstrate that sort of advice process. So short answer to replacing the advice process, no, Rob.
I mean, this is a bit about like the soft skills and things like that that the AI is not necessarily going to pick up on, isn't it? You know, it's that sort of interaction. Michelle, at the Newcastle, are they into AI in a big way?
Not yet. And it's happened. I don't know what number question we're on. We're on question 4. It's happened. I don't agree with the people on the panel. So I don't think it's going to replace people necessarily, but I don't know if anybody has been around teenagers or people in university. I've just spent a week with my niece and nephews in Spain, who are late teens, early 20s. I've also hired an intern and interviewed, I don't know how many interns, there's about 30 of them in the room. We have a changing landscape when it comes to AI and anything to do with the development of technology. And I think my opinion is it's foolish to think that you shouldn't embrace it, because if you speak to those first time buyers, they are on ChatGPT and all those other things every single day. So if you don't embrace it, you're going to be left behind. And to give you a really good example, I am now embracing it. I've redecorated my house using ChatGPT. I also had a complaint where I had with somebody, I can't really say who, but I had a complaint with a financial service. I uploaded their response letter and I asked ChatGPT to tell me where I was being deflected, if I was being manipulated, and could they do a full formal response using legal language. And I won. It took 30 seconds. So when you think about, and I was an advisor for quite a few years, how long it takes to write a suitability letter when you're thinking about I don't know some of your advice processes, but I worked for one place where if it didn't fit on the calculator, I had to fully explain. I went on this calculator, it didn't fully fit. If that can be completely removed and you're left with just speaking to the customer, that has to be a win. And everybody that I ever talked to, and I felt it the same, we all want more time to do the bit that we like, which is speaking to the customer. So I really feel like we need to embrace it, not just because it saves us time, but that is what the clients will start to be using. So the sooner we can do that, the better. We've also got a lot of people on TikTok. So slightly different from AI, who are doing lots of advice, and everything sort of intertwines. We've got a new customer base that want to know more about their finance. They want to invest more money in different ways. They want to be more creative. Loads of people have passive incomes now. And what goes in with that is that they're a lot more tech savvy. So I think it's foolish not to, give it a go and just to try and follow exactly what's happening and what your clients are seeing. But that's just my opinion. I could be wrong. When we might all be robots in in 10 years time. I'll be like, remember when I said this? But who knows?
Andrew, you want to ask?
Yeah, I just wanted to add on to that, because I think Michelle makes a good point, and I think one of the things I probably should have mentioned in terms of when you are starting to use AI yourself, particularly within your business, is there's a real danger of not doing this the right way in terms of keeping your own business safe. Like in terms of, you look at the amount of personal data, for example, that any brokerage, any financial services firm is going to have. It's not safe to just go plugging that into any sort of GPT, any Copilot. It needs to be the correct corporate licenses, enterprise licenses, all that sort of thing, to make sure it's keeping that data safe. So what I was just going to say is, there's all those considerations, and also ethical considerations about how customers know when interacting with a person versus AI as well. But if you haven't heard of it before, we've got something called the Accord Mortgages Growth Series, which is essentially a one-stop shop for advisors to help them grow their own business. And we've got lots and lots of content there in terms of how to start using AI in your business, and it's worth having a read of before that you sort of jump in feet first and can't undo something. I think there's some really valuable content. So I can put the link in the chat, actually, if that's any good.
Yeah, by all means. I mean, I've seen experiences of brokers using AI. One of them that jumps out is the fact that it uploads documents into it, and then they're able to compare the information across the documents, and it spots any anomalies between when you start to key it onto your application form, that there's actually any mistyping of national insurance numbers, date of births, or something like that. But I've also heard stories of where it can actually spot things that are fraud related. So, you know, you look at bank statements, and sometimes, you know, it's maybe the font's slightly different in a couple of places, and that sort of highlights that it knows that's a fraudulent bank statement. The same with pay slips and things like that it picks up those sort of anomalies. So I think that there's a value in AI that as Michelle said, you know, we should adopt it in certain tasks, but will it replace advice? I'm not sure yet we're really there. Ultimately, at some stage in the future, it probably will. Whether it will be in my and our lifetimes, I'm not so sure. But you know what, the progress of technology, you know, it will soon come around. But I think you've just got to be aware of it and embrace it wherever we can, as Michelle was saying. Just going on the onto the buy-to-let market now, because you all play in that space in some sort of shape or form. I've heard it described as being in suspended animation, and with all the problems that landlords are facing, with increasing costs, unclear regulation that's coming, and lenders being a little bit more cautious. A lender spooked by the Renters' Right Bill, and are you seeing any evidence of landlords exiting the industry? Andy at Leeds.
Yeah. So if I broke it down to two parts, then are we seeing evidence of landlords exiting? So I was fortunate enough to be on a call earlier this week with one of the leading national estate agency brands, and it was their senior executive team. And what they were saying is, in terms of our landlords leaving the industry, they are undoubtedly seeing people leave the space, and they're seeing risk of further attrition. But what they are actually seeing is they're having reasonable success at actually ensuring those landlords who do sell the properties is actually being bought by existing investors. So while the volume of landlords may well be reducing, the actual value of the lending to landlords is holding quite steady, is what they were saying. If I then came to the Renters' Rights Bill, we were on a call with a FS customer research company who've done a recent landlords trend survey recently using national resident landlord agency members. They asked a slightly different question around, do landlords have a good awareness of the Renters' Rights Bill? And some of the answers there were quite interesting. So the couple of things I wrote down were that 2/3 of landlords believe they have a good awareness of the Renters' Rights Bill coming up. So that's 2/3. Actually, those who had properties in a limited company were sick of the bill. And around 3/4 of landlords think the Renters' Rights Bill would be negative for their own lettings business. Interestingly, though, over 1 in 4 surveyed said they were only somewhat aware of what was going on with the Renters' Rights Bill, and that they were unclear on the main details. So there's an opportunity there in terms of learning and education, I'd say. They then asked the landlords where they would likely go for that education and learning. And what I found interesting again was that one of the highest things that landlords would go is they'd go and try and find it out themselves. So they do self-research, they'd go online and look on property websites and things like that. The other key area was using their letting agents. It was actually quite a low percentage that would go back to their broker or their advisor. Now, I know that won't be the case for anybody on our call, in terms of the advisors on our call, but what from my point of view, I kind of looked at that and said, that's a huge opportunity to potentially become a thought leader or you know, an educator in that space in terms of your own book and your own landlord's book, to educate them on what's coming down the track. And indeed, that leading national estate agency CEO, when he talked about his half-year results and he talked about the buy-to-let space, that was going to be one of their key focus areas, was making themselves a thought leader and educator in that space. So I do think there's a huge opportunity for brokers and advisors in becoming that thought, in taking that space themselves. Rob.
Okay. Jeff, Santander, what is it that you're saying there?
Yeah, I think what I'll do is I'll sort of add on to what Andy said, because he's made some really, really great points, to be fair. So I won't repeat anything he said, but what I will say though is that with the buy-to-let market, we've seen so many changes over the couple of years that's affected confidence in the market. So if we think back when the 5% stamp duty for secondary properties came in, that was going to end buy-to-lets, as it were, when it sort of came in. The changes to capital gains taxes, the rental reform, again, other tax changes. These have all affected confidence and people's confidence in the buy-to-let market, essentially. Now, what we've seen, obviously, is the majority of house purchases now that I've done for buy-to-let are through limited companies. But what we need to do is obviously just wait and see what happens also in the budget as well, because there could be information coming out of there that could further impact the buy-to-let market as well. So I think that the main important thing to remember is that we still do need a good rental sector. It is still important to the housing market overall and the economy overall as well. We do have limited social housing as well. And so we do need to make sure we do still have those rental properties available for people who are looking for those properties as well. And obviously we'll wait and see what happens with the market overall. But yes, I'll agree with the majority of what Andy said, to be fair. Just one thing is that we've been through a few changes on the buy-to-let market, and it still held fairly strong even throughout all the changes as well.
Andy, Andrew at the Accord, are there still opportunities for the buy-to-let market?
Yeah, I think so. I think you know, both Andy and Jeff there have covered some great points. I think what it does for me is highlight the adaptability of the landlord community and the resilience of it. I think that, you know, the opportunities are that whilst some exit, there will be more opportunities for those that look to consolidate, the professional landlords that are what I would usually describe as in it for the long haul. You know, that it is a business, not an on the side piece. And I think the key as well is that, you know, we absolutely fundamentally need properties from this tenure in the UK. Like, rental properties are absolutely critical to our housing market. Like, you know, if landlords all of a sudden disappeared, which obviously isn't going to happen, the customers that couldn't afford to buy the properties still couldn't afford to buy them, and the housing and the local authorities don't have any money to buy them either. So I think that it is just an opportunity for those that are, you know, in the more professionalised cohort and in it for the long haul to sort of continue on with that. I do think, though, from a lender perspective, there are, you know, we're in a little bit more of a stable environment now, obviously, over the last sort of 6 to 12 months compared to previously. There's probably some opportunities for us to start looking at what we can do from an affordability perspective to help landlords that are looking to, you know, refinance or potentially purchase. And I think that the other thing is, you know, there's all these challenges that landlords are facing, but actually the more sort of, if you want to call it, punitive measures that get levelled at landlords is the person that actually that hurts at the end of the day is the tenant. Because, you know, we talked about additional property tax there. There's rumours about, you know, national insurance contributions on rental income, all that sort of thing. Landlords are still going to do deals, but the only place that extra cost is going to go into monthly rent. So I think that the real challenge is actually for the tenant as well. So just as an aside, I did try to put that link in the chat, but I think it's just went to you guys, which isn't any good. So I'm not sure if there's a way we can get that to attendees afterwards.
Hold on. There we go. That should. Okay, we'll get that. We'll get that sorted. We'll get that out there.
Cheers.
Well, relate that with that sorted. When you said about things that lenders could do, do you think you're going to like offer higher LTVs in buy-to-let, or do you think that's you're at the maximum where you would be?
I think we currently offer up to 80% on buy-to-let, and I think that the problem you've got is, though, until until things significantly change in terms of rates or rental calcs, it's going to be hard to attain that. To pass the stress rates, for 80% is hard enough as it is. I think the further up the LTV banding you went, the more unattainable it would be. So I'll be honest, personally, I can't, certainly from a COD perspective, I can't see it anytime soon, but I don't know if anyone else would have a contradictory opinion on that.
Okay, all right. Well, Michelle, before we go touch on that, do you see any other opportunities? I mean, I think of things like holiday lets and things like that would be an opportunity still.
Yeah, it's really difficult for holiday lets to enter it because we've got a property shortage. And one of the things we have feedback on from our risk committees is it right for us to be, promoting holiday lets when there's a shortage of properties for, first time buyers, whatever else. And there's a lot of volatility with holiday lets right now and the taxation on it, particularly like you hear from my accent, I'm in Wales. We've got a whole host of things happening. There's still an opportunity, I think, but until everything settles down, we know exactly what tax implications are going to be in the next sort of 5 years or longer. It's really difficult to go sort of steaming into a new market area. If you're already there, a lot of the lenders who are already doing holiday lets do it really, really well, but it's difficult to enter that market if you're not already in it.
Okay, all right. So I'm just conscious of the time here, and I think we'll move on from that to, we've got a budget coming up at the end of November, which is actually the day before our annual conference. A little plug there for that. So yes, it will make the conversations interesting on the day. But the rumour mill's already started about possible tax changes and things like that. What rabbit would you like to see the Chancellor pull out of the red box for that to help the housing and mortgage market? Michelle, you've got the mic. Do you want to go first?
Yeah. Okay. Yeah. No problem. It's hard, isn't it, to pick one thing you'd like to see? I think right now, politically, Labour are under a humongous amount of pressure. I don't know if anybody else saw the headlines from Kemi yesterday about abolishing stamp duty, which has caught all the headlines. Really annoys me. Stamp duty was abolished in Wales and Scotland quite a few years ago, 22 for Wales. I think it was 2015 for Scotland. So when they're making these headlines and pledges, it actually is only affecting Northern Ireland and England. And they've pledged, obviously, not to hike up income tax, VAT, is it? National insurance, a whole host of pledges. I think if it was one wish list, it would just be something that supports the housing market for everyone, not just England and Northern Ireland, for the UK as a whole, and particularly where it comes to those fees, additional costs, whether that's capital gains, whether that's stamp duty, land transaction tax, which is what Wales and Scotland have got, something in there, because we need some good news. And right now, they haven't got a lot of options to do good news. But whatever they choose to do, I'm really hoping that it sticks and it doesn't have a U-turn in a couple of months' time, or it's something that they haven't thought of. So I'm going to remain positive. I know of speaking to quite a few lenders, all of our economists are poised for that announcement because they've got to do something. So, and one of the biggest ways to make a really positive impact is the housing market, or tax, or, something to do with money, isn't it? With the finances. So we'll just hope that it doesn't cause too much of a wave. I don't know if that answers it. I sound like a politician, don't I? Bit of this, a bit of that.
Jeff, do you want to have a stab at it?
Yeah, I'll go next. That's absolutely fine. And I think you did say one thing, Rob, but I'm going to be a bit greedy and say a couple of things, to be fair. So essentially, I'll say that the government this week, they actually said they're going to try and find ways to make the housing purchase timelines quicker and also try and find ways to reduce the cost as well. So if that was to be my rabbit at the hat, I'll say that's what I would like for it to be. So I would want those things to become true. It's something that would encourage more to buy, more to be able to move and right size, and also release more bedrooms into the market. And then that actually may mean that we don't need to build as many homes as, again, that 300,000 homes per year seems like it's going to be quite a feat.
Yeah. Interesting you say that about the speeding the process up. I don't know if anybody on the call has ever seen your fixing the broken chain report that Santander have put out. There's some quite startling facts in there, especially about youngsters being put off, and the stress that the house buying we all know causes. But the youngsters really do get impacted on it. And at a time when we're all concerned about everybody's mental health on various things, it's well worth taking some time and going onto the Santander website and having a look at that, because that's quite, it's quite a powerful report there. So I'd urge anybody to have a look at that for if they've got 10-15 minute coffee break to sit and have a read through that. It was very, very powerful. You could tell yesterday I was bored when I was coming back from London. And Andy at Leeds.
Yeah, so if I'm trying to say something a little bit different from the rest of the team, because I've made a list and I've been ticking them off as you've gone. So I guess for me, we need to raise money. There's a lot of uncertainty out there. This might be a bit controversial, and it is a personal opinion only. But if you take the politics out of it, maybe if we have to raise money, maybe it might just be a little bit easier and a little bit simpler to roll back from some of the manifesto pledges that they all talked about, all parties, in terms of not touching income tax, VAT, and national insurance, and maybe take the uncertainty out of it by just rolling back from that and sticking a penny on income tax, something like that. I know it's controversial, but that might just settle all that, take a little bit of that uncertainty out of things going forward.
I mean, the Conservatives making that announcement yesterday, it's easy to say when you're not in power, and they've probably got a long way before they can get back into power. They're all very well, these pledges, but come the manifesto when it's nearer the election, we might see it watered down a little bit, but still. Andrew at Accord, very quickly and finally.
Yeah, very quickly, I think totally agree in terms of we need to get more bedrooms, more stock on the market. I'd love to see something that impacts, stamp duty, buildings transaction tax, which gives people an incentive to downsize, because I think there's a lot of targeted support for first-time buyers at the moment, but we need to free up some of those other properties later on the chain. And yeah, we'll leave it at one because we've run out of time, but that's what I would go for. I don't think it'll happen, but that's what I would go for just now.
Thanks. Well, thanks a lot, guys. That is all we've got time for today. Thank you for the time. Thank you for your comments. And I'm sure that the team will be sending around a feedback form to all the delegates for their views on what's been discussed today. So once again, thank you for all your time, and have a great rest of the day, and look forward to the weekend when it arrives.
Thank you.
Thanks, Rob.
Cheers. Thank you all.
Take care.
Thanks.